Freedom and Prosperity Chairman Dan Mitchell, Manhattan Institute Senior Fellow Brian Riedel, and Independent Women's Forum Senior Fellow Patrice Lee Onwuka. All right, Patrice Lee, to you first. Does this rattle you, the fact that markets are still rattled?
It doesn't rattle me. I mean, I think we've been expecting there would be some pullback, some market correction to what has been a really extraordinary growth in the stock market. But again, the fundamentals of our economy are strong, and investors are just responding to that. Now, if this continues for another month, then I think there could be some cause for concern, and especially if we do see those interest rate hikes.
Dan?
I'm not quite as optimistic about that. I think that we've had a problem with central banks, not just in the U.S., but around the world, having too much easy money policy, holding interest rates artificially too low, flooding the system with too much liquidity. And at some point, that all sort of creates a bubble. And when that bubble pops, which might, of course, be happening, that's something to worry about. We went through this with the housing crisis last decade. The decade before that, we went through that with the tech bubble. When are we going to learn not to have central banks trying to manipulate the economy?
You know, Brian, he does raise a good point that the Federal Reserve and all these other central banks, maybe with the best intentions at the time, I think Ben Bernanke had said when all this was going down that he wanted to avoid another depression. But again, people get used to that cheap money. It was very, very cheap. It was at 0% for a while. So if you couldn't make money eventually or turn things around in that environment, well, then you were doing something wrong. Now they're saying, we mean it this time. We are taking the punch bowl away, and we are stopping this and reversing this. How do you think that's going to go?
Well, I think the economy right now is growing okay, and I think it's safe for interest rates to go up a little bit because, again, the economy is not at 1% growth.
What's a little bit, Brian? I mean, that's a hard one to peg, isn't it?
We're at about 2.5% to 3% growth right now, which is better than the 1% growth, which I think justifies normalizing interest rates a little bit more to what we have seen in the past, say, before the recession.
All right, well, that would be close to 4 or 5% on overnight bank lending rate, which is prohibitively higher than where we are now.
Sure, I think they can gradually rise as long as we don't see the economy react too negatively to it. I think the rates have been low for too long.
You know, Patrice, it's one thing to say that the president always talked up the market. Now he's not going to talk down the market or talk about the down market. But there are other things he can still refer to. These companies that are still reporting better than expected earnings, the job gains and all. Do you worry, though, that he is going to be marked because he stressed the market's going up so fast that regardless, they're going to remember more the market's reversing what he said?
I think that's only true of the media and the left, who are really trying to hammer him on the stock market now, but you kind of ignored the extraordinary growth over the past year. It's true that he did peg himself pretty closely to the market's rise, and so he's going to have to take a little bit of a hit. But when you look at all the other benefits that Americans are experiencing from their tax cuts that they're receiving this week and over the past week going forward, but also some of the good benefits, I think that will overweigh it. And when we look at his jobs approval rating or his approval rating, we're seeing that rise to a level that President Obama wasn't even at this time in his presidency.
Yeah, I think at the first 2010 period for President Obama, he was at about 48% approval rating, and this president's inching up to that. We'll see what happens. Dan, is it your sense that the good economic news, the tax cut that seems to be a pay-it-forward thing with a lot of companies sharing the loot, the unexpected sight of seeing this in people's checks as they look at their higher net pay, that will win out over the crazy markets?
If 6 months from now we haven't experienced some sort of 2008 meltdown, I don't think people will even remember that we've had a couple of days of down markets. But I'm worried that we might see more of that kind of bad news because central banks have put us in a position where there probably is somewhat of a bubble in the economy. Now, having a good tax reform bill, yes, that helps stabilize things. It's helping to show up. It's showing up in people's paychecks. It's showing up in investment decisions by companies. But let's consider the other side of the issue here, spending. This new budget deal, I think, in the long run, makes it much less likely that we'll be able to sustain lower tax rates, and maybe that's some of the nervousness we're seeing on Wall Street.
Well, it's certainly among the noisy items they've raised. Brian, does it make a lot of negative noise to you?
If I'm an investor, I'm concerned right now. The budget deficit is probably going to move to about $1 trillion next year.
Yeah.
And it's going to soar to about $2 trillion a decade from now. That's going to spook investors. I think it's right to price in some difficult decisions going forward. We may not be able to sustain the tax cuts if lawmakers don't get spending under control. Additionally, if interest rates do go up, every point they go up is going to raise the deficit about $150 billion in interest costs. So if I'm an investor, I'm a little nervous about what's going on in Washington.
All right, guys, I want to thank you all very, very much.